Every year, governments make difficult choices about how to spend public money. For many developing countries, those choices are becoming increasingly constrained because a growing share of national budgets is going towards servicing debt instead of investing in development. Today, 3.5 billion people live in countries that spend more on debt servicing than on health or education. In 2024, developing countries spend nearly 10% of government revenues on interest payments alone. And in some of the least developed countries, external debt service consumes up to a quarter of public revenues. That is why sovereign debt matters. Now, borrowing itself is not the problem. Governments borrow to finance development, build infrastructure, expand access to education and healthcare, or respond to crises such as pandemics, conflicts, or natural disasters. When debt is used well, it can be a very important tool for economic growth and development. The challenge arises when borrowing becomes too expensive or difficult to repay, especially when countries are hit by external shocks beyond their control. And recent global crises have made that challenge even greater. Why is this happening? Part of the answer lies in how sovereign borrowing has changed over time. Several decades ago, developing countries borrowed mainly from other governments or international institutions such as the World Bank. Today, countries owe money to many different types of lenders, including private investors, commercial banks, regional institutions, and new bilateral creditors. This has created more opportunities to access financing, but it has also made the system much more complicated. Financing has become significantly more expensive for developing countries. According to UNCTAD's latest analysis, the average cost of external borrowing for developing countries has more than doubled since 2014, while loan maturities have become shorter. Our analysis further estimates that if 94 developing countries could borrow at the same rates as developed economies, they could collectively save around $500 billion each year in interest payments. Just imagine what those savings could finance. Let me tell you, they could finance around 375,000 schools or more than 1.3 million primary health clinics. Now, at the same time, financing has become much more volatile. Capital often flows into developing countries when global conditions are favorable, but disappears precisely when countries need it most. Another major challenge is that sovereign debt is extremely difficult to restructure. Unlike companies, countries cannot declare bankruptcy through a single international legal process. There is no global sovereign bankruptcy system. Instead, debt restructurings are negotiated case by case among multiple groups of creditors, each with their own interest and legal frameworks. These negotiations often take years, prolonging uncertainty and delaying economic recovery. Recognizing these challenges, countries meeting at the 4th International Conference on Financing for Development last year called for reforms to strengthen the international debt architecture and improve support for developing countries. One practical initiative emerging from those discussions is the Borrowers Platform. For decades, official creditors have coordinated through mechanisms such as the Paris Club. Borrowing countries, however, have never had a comparable space to exchange experiences, strengthen technical capacity, and develop common perspectives. The Borrowers Platform seeks to fill that gap. UNCTAD serves as the secretariat of this member-led initiative. Earlier this year, more than 30 developing countries came together to launch the platform, creating a space for peer learning, technical cooperation, and strengthening borrowers' capacity on issues such as debt management, legal expertise, and innovative financing. As the United Nations Secretary General noted at its launch, the platform is an important step toward ensuring that developing countries have a stronger voice in shaping a fairer international financial architecture. Let me end with one simple message. Debt should serve development, not undermine it. Achieving that will require not only responsible borrowing and lending, but also stronger international cooperation and a financial system that gives developing countries a fair opportunity to invest in their future. Thank you.